So first off, Professor Plum, when we say volatility, people equate the markets, I think, with volatility. But what are we talking about? What is it? How would you define it?
Movement in price. I mean, volatility is the upward and downward movement of price. Now, most people don't care about the upward. They like the upward movement of price, but that's still volatility. Downward is where we're worried about moving our price down, moving to a lower value. And all investments have some form of volatility. CDs are cash. Their risk is a different type. They don't have volatility. They're also just a holding place for value. They're not really investments so much as I would call them, but investments, bonds, stocks, commodities, real estate, and anything that has the ability to go up in value more than just a placeholder of cash, it has risk. What kind of risk? Well, one of the main risks that people focus on is the movement. And typically they only focus on the downward potential movement. That's the volatility. Upward, downward, we have to measure the movement, the unexpected, so to speak, movement, although it's totally expected, that the value of a stock, the value of a bond is going to move on a daily basis. The current value of that investment, if I were going to try to sell it or buy it, is going to be higher or lower than it was 5 minutes ago, 10 minutes ago, yesterday, a week ago. That change in value is the volatility. What we're trying to do is get into something when it is X price and get out of it when it is X plus. We try to avoid getting into it when it's X and selling it when it's X minus. So but unfortunately, we can't predict what's going to happen. There were times where, if you look at companies and you say, wait a minute, this company has increased revenue, increased market share, increased productivity. Everything it's doing is doing really, really well. And you look at the price of the stock and it's going down. Well, why? Well, it's just things that happen in the market. We've also seen companies, especially, back in the 90s, there were companies that had no chance of ever surviving, no chance of making a profit. Their cash burn rate was going to put them out of business in 15 months. And at their best projections, they would see a product revenue 3 years from now. And people were bidding the living heck out of it.
Weren't they, though?
Forget PE. E is earnings. They didn't have any earnings.
There were
they
no
didn't ever expect to have earnings, but people were buying it because because it was on an upward trajectory, right up until it wasn't. And that volatility is what we are trying to use to make money, but it goes the other way too. And it goes the other way in times where you cannot predict.
Absolutely.